imagine you've lived in the same house for, I don't know, over a decade, right?
Okay.
And frankly, it's developed some serious issues. Like the roof leaks a little bit during heavy rain, the plumbing makes this horrible groaning noise, and the basement is just packed to the ceiling with clutter.
No, the kind of stuff you just sort of learn to live with.
Exactly. You just kind of live with it.
Yeah.
It's functional, but, it's a mess.
Right.
But then one year, you finally decide to get your act together. You fix the roof, you replace all the bad pipes, you clear out the basement, you even put a fresh, modern coat of paint on everything.
Sounds like a lot of work.
Oh, tons of work.
Yeah.
But the house is finally perfect. I mean, it is running like a well-oiled machine. And then the very next morning, you walk out and hammer a for sale sign into the front lawn.
Which is, it's a completely counterintuitive move when you first look at it.
Yeah.
You put yourself through the absolute grueling misery of an extreme renovation only to decide, well, you aren't going to be the one living there to enjoy it.
Right, exactly. And that specific paradox, doing a massive, painful foundational cleanup, only to immediately explore handing the keys to someone else, that is exactly the scenario we are unpacking today.
It's a great one.
Welcome to the Deep Dive. Our mission today is to explore a really fascinating corporate turnaround executed by a specialized technology manufacturer called AstroNova.
Yes, AstroNova.
We are going to look at their recent, what they call a foundational reset, and what their journey reveals about the mechanics of business strategy. The gravitational pull of recurring revenue and how to perfectly position a company for a massive payday.
It really is a brilliant textbook case study in corporate leverage. But before we get into the weeds of their strategy, I'd ask you, as you're listening to this, to think about your own industry.
Yeah, your own professional environment.
Exactly. Like, how often do we evaluate a company or even just a department and assume that a flat or slightly declining top-line revenue automatically means failure?
All the time.
Right. When in reality, if you understand the mechanics beneath the surface, that flat revenue might be masking a deliberate, highly profitable optimization.
That is exactly the lens we need today. And to guide this exploration, we have a stack of freshly released financial documents. We're looking at AstroNova's fourth quarter and full year fiscal 2026 financial results.
So this is recent?
Very recent. This includes their earnings call presentation, the official press release, and some very telling excerpts from their Form 10-K, all dated April 2026.
And just to establish who AstroNova actually is, for anyone unfamiliar, they are a global provider of specialized data visualization and printing technologies.
Right, but we should clarify.
Yeah, we need to be clear. We are not talking about, like, the plastic inkjet printer sitting in your home office that jams every time you try to print a shipping label.
Oh, definitely not.
No, we are talking about highly regulated, mission-critical, industrial-grade environments, flight deck communications and commercial aircraft, medical device labeling, hazardous chemical tracking.
The kind of hardware that simply cannot fail without causing a massive logistical or, safety crisis.
Exactly. High-stakes stuff.
So to understand why AstroNova is suddenly hammering that for sale sign into the lawn, which, by the way, they officially refer to as exploring strategic alternatives, we first need to look at what CEO Jörg Gittmann and his executive team actually spent fiscal 2026 doing.
Right. Because they explicitly called it a foundational reset year.
And if you were only skimming the highest level vanity metrics, you would completely miss the success of that reset.
Oh, absolutely.
For instance, look at their total revenue for the fourth quarter. It was $37.5 million.
Which doesn't sound bad.
But that is an increase of just 0.5% year over year. And for the full fiscal 2026 year, revenue sat at $150.5 million, which is actually a slight decrease from the prior year.
Yeah, and on Wall Street, flat or slightly declining revenue usually triggers a panic.
Totally. The assumption is that the company is stagnating or losing market share or just failing to innovate.
Right, but that top-line revenue is just, it's just the paint on the outside the house.
Okay, let's unpack this. Because the real story in these documents is the financial plumbing.
Exactly.
They spent the entire year fixing the underlying structure and basically ruthlessly paying off the credit cards. So it's not the glamorous stuff that generates viral headlines, but it completely alters the company's survival trajectory.
What's fascinating here is how it perfectly illustrates the difference between vanity metrics and sanity metrics. The market just obsesses over top-line growth.
Yep.
But AstroNova's leadership team proved that disciplined cash generation and aggressive debt reduction are what actually buy a company's strategic freedom. I mean, if you look at the balance sheet,
It's pretty wild.
it is. In the fourth quarter alone, they eliminated $2.7 million in debt. For the full year, they paid down $9.1 million. Their total debt now sits at a very manageable $37.6 million.
That is a staggering amount of debt to eliminate in just 12 months for a company with $150 million in total revenue.
It really is.
And, I mean, you can't pay down debt with accounting tricks, right? You need actual cold, hard cash.
Which is exactly what they focused on generating. Their operating cash flow massively improved.
Oh, I saw this.
Yeah, they generated $11.7 million in operating cash in fiscal 2026.
Wow.
And to put the magnitude of that into perspective, the year prior, they only generated $4.8 million.
Wait, so they more than doubled it?
They more than doubled their cash generation engine, yeah. And they ended the year with $15.9 million in liquidity. So they are maintaining this very comfortable safety cushion while aggressively deleveraging the business.
And part of finding that cash meant getting incredibly lean. I noticed their operating expenses plummeted in the fourth quarter. It dropped down to $11.3 million from $24.5 million in the same quarter the previous year.
Right, but looking closer at the documents, we have to put a huge asterisk on that massive drop.
Yeah, good point. That previous year's $24.5 million included a $13.4 million goodwill impairment charge.
Yes, and that is a critical piece of context. When you see an expense line get sliced in half literally overnight, you always have to check the footnotes for one-time anomalies.
Right. And just looking at the mechanics of a goodwill impairment, essentially, when a company acquires another business, they often pay a premium over the actual value of the physical assets, right?
Exactly. They're paying for intangible things, like brand reputation or customer lists.
And that premium goes on the books as goodwill. But if that acquired company underperforms years later, accounting rules force the parent company to, admit they overpaid.
They have to write down that value.
Exactly.
It is a harsh accounting reality check. Now, it's a non-cash charge, meaning AstroNova didn't actually write a physical check for $13.4 million that quarter.
Right.
But it takes a massive bite out of their reported profit. Taking that impairment charge last year was a huge part of the foundational reset.
It was basically leadership clearing out the historical baggage.
Yeah, acknowledging a past misstep and just wiping the slate clean so the balance sheet finally reflects reality.
So if pulling off this massive debt paydown and foundational reset required a huge influx of operational cash, we have to look at where they actually found that cash.
Yes.
And ironically, based on the segment data, they found a huge chunk of it in a division where they were technically making fewer sales, which is their aerospace segment.
It is a phenomenal dynamic. Let's look at the raw numbers for aerospace in Q4. Their sales actually declined by 4.1% year over year, landing at $11.2 million.
Okay.
Now, leadership noted this was primarily driven by the timing of customer projects.
Because the aircraft cycle is so long.
Exactly. We have to remember the commercial aircraft manufacturing cycle is incredibly slow and massive. A delay at a major manufacturer like, say, Boeing or Airbus creates a massive ripple effect.
Right.
Which means suppliers like AstroNova see these lumpy revenue quarters depending on exactly when those planes are built.
I'm looking at these numbers, though, and there's a total disconnect. Aerospace revenue is down 4%, but their operating profit in that same segment jumped by 24%.
Up to $2.3 million.
Yeah. I mean, unless they drastically slash the cost of manufacturing these printers, that math doesn't add up. How are they making significantly more money on fewer sales?
It sounds like a paradox, but it all comes down to a concept called product mix. To understand it, think about a microchip manufacturer.
Okay.
Let's say one year they make millions of cheap, low-grade chips for musical greeting cards, but the next year they pivot. They only make a few thousand highly specialized, radiation-hardened chips for military satellites.
So total volume plummets.
Exactly. Their top-line revenue might even dip, but because the profit margin on the satellite chips is astronomically higher than the greeting card chips, their actual take-home profit surges.
Oh, okay. So AstroNova shifted their mix toward the satellite chips, metaphorically speaking.
Exactly. They're selling fewer items, but much higher margin items. In AstroNova's case, their flagship product driving this is the ToughWriter printer.
Or the ToughWriter.
Yeah. This is the heavy-duty hardware sitting right there in the flight deck of commercial airplanes. It prints weather maps, communication logs, critical flight data.
Which means it has to be incredibly resilient.
Oh, absolutely. To get certified for a flight deck, that printer has to survive severe turbulence, rapid pressure changes, extreme temperature fluctuations, constant vibration.
Wow.
And the engineering required to achieve that certification means they can command a massive premium. Plus, the ToughWriter now represents over 80% of all their flight deck printer shipments.
And despite the lumpy revenue this quarter, the future demand looks incredibly strong. I mean, their book-to-bill ratio in aerospace is 122%.
Which is fantastic.
Yeah, meaning for every $100 of product they ship and bill for today, they're booking $122 in new future orders.
That builds a backlog, which currently sits at $12 million.
Right.
That backlog provides management with crucial visibility into the future. They know that high-margin revenue is locked in. But there is another mechanism driving profitability in aerospace, and it's basically buried in a single sentence in the report.
Oh, I know what you're talking about. This was my favorite detail in the entire document.
It's incredibly elegant, isn't it?
So good.
The report notes that a major legacy royalty obligation in the aerospace segment is lapsing in the third quarter of fiscal 2027.
Okay, so what does that mean?
When that legal obligation expires, it unlocks an additional $2 million in annualized gross profit starting in the fourth quarter of that year.
That is $2 million dropping directly to the bottom line, just pure profit.
Yep.
They don't have to engineer a new product, manufacture a single extra printer, or hire another sales rep to get that money.
Not at all.
The historical expense just vanishes. It's a great reminder to look for the hidden levers inside a company's cost structure. Sometimes the biggest boost to profitability comes simply from outliving a bad legacy contract.
Right. It instantly transforms their margin profile from the inside out.
Okay, so aerospace provides these high-margin, lumpy bursts of profitability tied to long aircraft manufacturing cycles.
Yes.
But that kind of unpredictability doesn't provide the steady, month-to-month cash flow you need to confidently pay down $9 million in debt.
No, it doesn't.
That steady cash had to come from somewhere else. Which brings us to AstroNova's other half, the product identification segment, or product ID.
And this segment operates on a completely different set of mechanics. Product ID brought in $26.3 million in Q4, which is a 2.5% increase year over year.
Nice and steady.
Exactly. This is the side of the house that designs specialized label printing solutions.
Here's where it gets really interesting to me, the business model. Because the printers themselves are highly engineered, sure, but the hardware is really just a delivery mechanism. This is a flawless execution of the classic razor and blade model. You sell the razor, right, the printer, knowing the customer is completely locked into buying the replacement blades from you indefinitely.
It is the holy grail of hardware manufacturing. If we connect this to the bigger picture, in the product ID segment, a staggering 80% of their sales come from aftermarket revenue.
80%.
Yeah. That means 80% of the money generated here isn't from selling the machine. It's from selling the recurring consumable supplies.
Like the ink and labels.
The specialized ink, the proprietary toner, the labels, and of course, the ongoing maintenance service.
Wait, I was thinking about the verticals they target too.
Yeah.
Because they do healthcare, life sciences, chemicals.
Right.
In those industries, a label isn't just a sticky piece of paper used for, branding or looking nice on a shelf.
Not at all.
It's actually a compliance component. If the dosage label falls off an IV fluid bag in a hospital, or the hazard warnings smear on a barrel of industrial solvent, that product is medically and legally useless.
Exactly. It cannot be sold or utilized.
Wow.
And that is the exact mechanism that makes this model so powerful. The stakes of failure are simply too high. I mean, a chemical manufacturer isn't going to risk $1 million international shipment being rejected at customs because they tried to save a few pennies by purchasing some off-brand label ink that couldn't withstand a humid cargo ship.
Of course not.
They are going to buy the certified, tested AstroNova supplies every single time.
Which creates an incredibly sticky customer base. Once that printer is installed on the factory floor, it just becomes a money tree that reliably drops fruit month after month.
A very consistent money tree.
And they're actively expanding the footprint of that forest, too, because the documents highlight their May 2024 acquisition of MTX News Solution.
Yes, and understanding how MTX fits into the strategy is crucial here. MTX specializes in mid to high volume digital printing for packaging.
Okay.
So AstroNova is moving beyond just printing a small label to stick on a box. They're moving into printing directly onto the industrial packaging itself, right on the customer's assembly line.
Oh, wow. Which obviously requires larger machines. And those machines are handling massively higher volumes of material, which means they are consuming dramatically larger quantities of proprietary ink.
You've got it. It entrenches them even deeper into the industrial supply chain.
That's brilliant.
And their go-to-market strategy for this expanded portfolio is clearly resonating. Look at Q4 orders in Product ID. They were up 2.9 million year over year.
Nice.
They built a backlog of 13.5 million with a 104% book-to-bill ratio. The recurring cash engine is fully stabilized and growing.
So what does this all mean? If we pull all the threads together, we finally see the full picture. AstroNova has successfully executed a grueling turnaround.
They really have.
They've eliminated over $9 million in debt. They have an imminent $2 million pure profit boost coming in aerospace. And they have this highly lucrative, compliance-driven, recurring revenue engine in Product ID that just reliably prints cash.
Right.
The foundation is fixed. The house is gorgeous. And that is exactly when the board of directors drops the bombshell.
Yeah. On April 7th, 2026, the board formally announced they are reviewing strategic alternatives to maximize shareholder value.
Like we said earlier, they staged the house perfectly, and now they're inviting buyers to take a tour.
Exactly. The announcement explicitly lists options like a sale of all or part of the company, a merger, or some other business combination.
Though, as is standard practice, they do include the caveat that they might just continue operating under their current independent strategic plan.
Well, they have to maintain that leverage.
Right.
Their official outlook for fiscal 2027 projects mid-single-digit revenue growth and an expanded adjusted EBITDA margin, which signals to the market that they are perfectly content and highly profitable just staying independent.
And just to quickly translate for anyone listening who doesn't spend their life in financial spreadsheets.
Please do.
When they project an expanded adjusted EBITDA margin, that is really just a fancy accounting way of saying their core day-to-day operations are going to become even more profitable, ignoring things like taxes, interest, or one-time write-offs.
Exactly. It measures the pure operational profitability of the business engine.
Right.
But this entire sequence of events brings us to the core strategy of mergers and acquisitions, because this raises an important question.
What's that?
Why go through the agony of the turnaround before exploring a sale? Why not just sell the messy house a year ago and let a massive industrial conglomerate fix the plumbing?
Because of the massive difference in valuation.
Precisely. Corporate valuation is entirely about risk and leverage. If AstroNova had tried to sell themselves a year ago...
When things were a mess.
Yeah, when their debt was much higher, when their margins were less efficient, and critically, before they took the medicine of that $13.4 million goodwill impairment.
They would have been categorized by buyers as a distressed asset.
Absolutely. And a buyer looking at a distressed asset is going to demand a massive discount.
Right. They'll argue, look, your balance sheet is a mess. We have to spend our own money to fix your operations, so we are only going to pay you a multiple of, I don't know, maybe 4 or 5 times your earnings.
Right. The buyer absorbs the risk, so the buyer demands the upside. But by doing the grueling work themselves...
Proving the cash flow model.
Exactly.
Yeah.
By proving the cash flow, eliminating the debt, securing the recurring revenue, and building out the backlog, AstroNova basically reversed the leverage.
Right.
They aren't asking a buyer to take a gamble on a turnaround story anymore. They are offering a fully optimized turnkey profit engine.
So a clean, high-margin business with 80% recurring revenue in its largest segment commands a massive premium.
Huge.
Instead of a 5x multiple, a strategic buyer might be willing to pay 10x, 12x, or even 15x earnings to acquire that kind of reliability. By waiting until the house was perfect, they exponentially increased the ultimate payday for their shareholders.
It is a masterclass in controlling your own destiny. Whether they ultimately sell to a larger conglomerate or just continue as a highly profitable independent entity, they built the leverage required to force a fantastic outcome either way.
It really is impressive. It proves that aggressively managing your balance sheet, leveraging your product mix for margin over volume, And, designing a business around essential, compliance-based recurring revenue. Those are the ultimate prerequisites for strategic freedom.
Definitely. And I think analyzing this turnaround leaves us with a really compelling, broader question to consider for the future.
Oh, what are you thinking?
Let's say AstroNova does get acquired by a massive multinational industrial conglomerate.
Okay.
What happens to these hyper-specialized niche technologies once they are absorbed into a corporate giant?
Oh, that's a good point.
Think about the engineering required for flight deck communications or the chemistry needed for mission-critical industrial ink.
Right. Does the parent company just treat it like a cash cow?
That is the risk.
No.
Does corporate consolidation in these highly specific B2B hardware markets stifle future innovation? Because the conglomerate might just milk that 80% recurring revenue without reinvesting in the underlying technology.
Just coasting on it.
Exactly. Or, conversely, does an acquisition actually give these vital niche technologies the massive global distribution scale and the deep-pocketed R&D funding they desperately need to evolve to the next level?
Man, that is a fantastic question to leave off on. Does the new owner just collect the rent on the freshly painted house? Or do they actually use their resources to build a massive new addition?
Time will tell.
Thank you so much for joining us for this deep dive. Hopefully the next time you walk past a mundane-looking commercial printer in a hospital corridor, or you spot a weather-beaten hazard label on a shipping drum, you look a little closer.
There's always a story.
Always. Because behind that seemingly boring infrastructure, there's usually a fascinating, highly strategic business engine quietly printing money. We'll catch you on the next one. Keep an eye out for those freshly painted houses.